Hello, welcome to the next in our series of podcasts on demystifying IFRS 9's impairment requirements. I'm Sandra Thompson. I lead our global accounting technical function for financial instruments. I'm here today with Hannah King. Hannah's in my team. She also spends all her time working on impairment, and she spent some time at the ITG helping them with their work. We're going to talk today about what's disclosed for 2016 year ends. This is something of a hot topic. So Hannah, before we delve into the detail, can you give us some background?
Yes, IFRS 9 comes into effect for 2018 year ends, but accounting standards require disclosure of the potential impact of those standards in the periods leading up to their adoption. So that means 2016 year end disclosures. But IFRS 9 represents such a fundamental change for banks. The expectation is that banks will be disclosing much more than they might otherwise do. The EDTF, that's the Enhanced Disclosure Task Force, issued a report last year which gave recommendations and best practice disclosures for large internationally active banks. Now these are also relevant to other financial institutions, but they considerably raised the bar in terms of the level and extent of disclosures that are expected. In addition, regulators are concerned about the fact that some banks may not be as far advanced in their implementation planning as they could be, and have also been calling for more relevant and transparent disclosure in the financial statements. In Europe, ESMA has made this a particular enforcement priority for 2016. And in the US, SEC staff have also made an announcement calling for greater disclosure in this area. So Sandra, what sort of disclosures might we expect to see in the 2016 financial reports?
Well, Hannah, I guess the question I'm most often asked is, will banks disclose a number, i.e. the quantitative impact when IFRS 9 is first adopted? It's too soon to know. There's no absolute requirement to disclose a number, and it is possible that some banks may do so. However, when I talk to banks, most seem to think they are not ready to disclose a number, and there's two main reasons for that. One is that their implementation plans are just not far enough on. They're still building models and gathering data, and in particular they haven't done a parallel run, so therefore they're just not sure enough that any number is indeed the right one. The second reason is that the impact of adopting IFRS 9 will depend on economic conditions at the start of 2018, and of course we don't know what those will be. And in particular with Brexit and the recent US election, we are facing a lot of uncertainty just now. So for numbers not disclosed in 2016, when will banks be ready? Well, ESMA has given a very strong steer that they expect to see a quantitative impact at the very latest in 2017 financial statements, but quite possibly in 2017 interims. The other thing to bear in mind that if some banks do give a number and your bank is not doing so, will you want to catch up with your competitors and be ready to come out with some kind of quantitative information? The final thing is, even if you're not prepared to disclose a number, that doesn't mean you have nothing to do. So Hannah, can you talk a bit more about what other disclosures might be given?
Yes, well the extent of qualitative information that's given in financial reports will vary from entity to entity, depending on how far advanced banks are in their implementation plans and also their specific products and businesses and how it impacts them. But whereas in 2015 we generally saw quite high-level disclosures about the concepts in IFRS 9 and how they might differ from that in IAS 39, what we're expecting this year end is for banks to be giving much more detailed and granular information about what those concepts really mean for them and how they're implementing it in their business. In addition, the EDTF and ESMA are also asking banks to disclose something about the credit risk modelling techniques they're planning to use. For example, are they going to use a PD rate based on regulatory information, or a loss rate basis, or some other? And how will this vary between their different portfolios and their different books, such as retail and wholesale? In addition, banks are being recommended to disclose the impact on their capital planning. Does management have to make any changes to their strategy in this area? And what are the uncertainties due to the regulatory regimes being unclear or not yet fully developed? And finally, banks are being asked to disclose their implementation strategies. What's their timetable and what significant elements do they still have to implement? So as you can see, there's a lot to disclose in 2016 financial reports, and it's going to take some time to pull all this information together and get it ready.
Thank you, Hannah. So although we still have a full year until IFRS 9 is implemented, there is plenty to do at this year end. This is a hot topic, it's an area of regulatory focus. Some banks may give a number, but even if you don't, there's still plenty to be disclosed. And we're expecting banks to move away from generic type disclosures about what IFRS 9 says into disclosures that are much more specific to them, including implementation plans, the kind of modelling being used, impact on capital strategy. Thank you for listening. I hope you'll join us next time when we're going to talk about credit cards and other revolving credit facilities. And if you'd like to subscribe for the whole series, please click on the subscribe button on your screen. Bye-bye.